Hi everyone, this is Michael Bengiat with Lifetime Investor, and this is the Market Trend Advisory Weekend video for September 3rd, 2022. Before we start, here's our disclaimer. You can take a look at that. And this week we had quite a lot went on, not positive for the market though. In the Nasdaq, we actually saw just a complete reversal, and we had what's called a circuit breaker on Tuesday, which kicked us out completely from any exposure. And that circuit breaker took us down to a market count of 0, no exposure. The buy switch turned off, which means you can't even buy anything at this point. And so we have no exposure. We also just, because of the poor action in individual stocks, put that down to no exposure. And we also had a number of institutional selling days that started coming into the market. That's been affecting both the S&P and the Nasdaq. So in terms of the Nasdaq, we're completely out. The S&P, we're down to just one market count, which gives us 30% exposure. And that looks likely probably to go to 0. I would expect that. I think we're going to be testing the lows. And so it's not looking good for the market. You can basically see, I think a week ago we were a lot of green. Now we've got a lot of red. And the market just did not like what Powell, Fed Chair Powell said, that in effect, interest rates will probably be higher for longer than anyone expected. So I think that's actually good because he didn't cave. A lot of times they tend to cave and just to Wall Street's pressure from Wall Street to do what's right for Wall Street. And I think he's realized that we have a much deeper problem going on in the country in terms of inflation, so it's going to take some hard medicine. And I think the market's now pricing in that it's almost going to be inevitable that we're going to have a recession, because that's the trajectory that we are going into. So so the market's not liking this. So I'd say just expect probably lower prices and no exposure in the S&P probably shortly. We didn't get a circuit breaker in the S&P, but we're pretty close. I think another 50 points lower, and that will trigger that, and then we'll be actually completely out. And what will turn this back on will be a return to an uptrend. That will turn the buy switch back on. But it doesn't look likely, but of course, being the stock market, anything can happen. The market's looking for any kind of good news. We had the jobs report on Friday, yesterday, and the market initially rallied pretty strongly, but it just succumbed to selling. So you have to remember too, we're in a bear market, and in a bear market, you'll get strong openings and weak closes. That's one of the hallmarks, and the reverse is in a bull market. So we're seeing that. We're also entering what's the worst month for stocks, which is September. So just in terms of that cycle, the market tends to head down and bottom in October. And we don't know if that's going to happen here. It would kind of make sense if we went down, tested, or even made new lows below the June lows. And if we bottom from there, that would be kind of fitting. We do have, just in terms of cycles, going into the presidential cycle and other ones, the market tends to bottom here, and then for the next couple of years head higher. But of course, we're coming off basically a super cycle bubble, which I think may just negate the whole that whole pattern that's been in place. Not always, because nothing works always in Wall Street and in the stock market, but it's been in place for a long time. But we're getting a lot of just different behavior now that we're no longer with all these headwinds or tailwinds for the market in terms of lower interest rates, accommodative Fed, and all that. So I think we're probably due for a bigger correction than anyone really expects or wants. But in a way, it's healthy. The market just, when it goes into these super cycle bubbles with extremes of everything, extremes with these meme stocks, with just interest rates at 0, free money, just excessive optimism, as I said before, crazy trading where stocks go up 100% in one day. We saw this 22 years ago, and that it all got wiped out and eventually bottomed out. And those bottoms are actually fantastic investing opportunities, and we will get one at some point. And that's what we're waiting for. We just don't know when it's going to be. So let's move on to our investing strategies. We're, in terms of the QQQ, we're just soundly beating it. We're down less than 10%, and the QQQ is down 26% almost. And for the SPY, we still have a little bit of exposure, 30%, but we're still beating the SPY buy and hold with our system. So that's good. For the Nasdaq, here's the chart. You can see we didn't even get up to the 200-day, which is declining, and it's this black line. And we just went straight through, cracked right through the 50-day, which is this red line. Didn't even get up there on Friday. And so as you can see, it's acting as a resistance up here. Now the S&P really gave us some textbook sell signals here. We had the one coming up exactly to the 200-day. That's where a lot of institutions ended up stepping up and exiting. And you can see here yesterday, we came right up to the 50-day and we end up closing near the lows. So this is classic bear market action. And it does look from the what we've seen just historically, it would be very likely to test the lows on both of these. And I wouldn't be surprised to see it break. But we shall see about that as it develops. In terms of technicals, you can just see from just the color coding, we're just getting 52-week lows or just swamping 52-week highs. You know, we had almost 10-to-1 here on Friday. The number of growth stocks that have just recently broke out just really has started to sink again. You know, we were up in the 60s and we were just 40 just earlier, I think on Monday or last Friday, and now we're down to 9. Up volume versus down volume. We have the same thing. We have a drop here just coming down. So it's not looking good. We're now starting to come back. We're now below the 50 days. You can see here we were above it on the Nasdaq, 11.7%, and now we're down 3.3%. So you can see this has already made a 14% decline just since the 15th. So in basically a little more than 2 weeks. So it's not looking very good. Sentiment, we're starting to get back into fear. We had a little brief run into neutral territory. The investors' intelligence, we're in bullish territory. Overall, this was actually a little bit bullish to neutral. We're starting to come back to neutral, adding a little fear, which would make sense as we decline. But it's still a little too bullish, I'd say, overall, for the market to put in any kind of bottom based on sentiment. So it's never boring in the stock market. It's always interesting things to try to interpret and see where we're going. But I'd say overall, the picture is pointing towards lower prices. And that's where we are. As a final thing today, I've had some questions about this, about our Nasdaq and S&P based individual stocks and the non-index ETF action signal. So one of the questions is, let me get rid of that, has been, some people said, hey, how come we're getting such a big divergence? Just a week ago, the indexes were about 100% exposure, and we were just down at 15% or maybe even 25%. So I want to talk a little bit about that, because this column here is very, very, it's powerful. It looks like just another simple column, but a lot is going into this, and it's been a very good leading indicator of what is actually going on in the stock market. So I wanted to just talk a little bit more about this. So what's going into this exposure here is a lot of things. We have 8 things that we're looking at in terms of how leading stocks are acting. Actually, before I go to that, I want to talk about what is a leading stock, because this has been something that people have said. So I've brought up here a chart of Alphabet, and this is a weekly chart. And you can see here, it's been a nice performer since the bottom in 2020, but you can see we've rolled over. And in fact, it looks like we're forming this kind of a ledge pattern, and I would not be surprised for this to break down. And this, if you look at charts of Microsoft and Meta, which was Facebook, and Netflix has really just broken down. So, but these are not leading stocks anymore. Leading stocks are the ones that are actually outperforming the market. Now, on these charts, we always get this relative strength line and relative strength number. And you can see Alphabet has a relative strength of 35. What does that mean? It means that 65% of stocks are outperforming Alphabet. That's not a leading stock. That is a lagging stock. And you can probably argue too, this has had made a huge run over the years. It's become just a mega cap company. And it really just probably will never be the true leader it ever was. It's too big and it can't move the way it did and have its massive growth in sales and earnings like it did. Just like Apple has become the same thing. It's not going to grow at the rates that it did. Now, I'm going to compare this to a company called Lantheus, which you've probably never heard of, but look at the difference. We have a relative strength of 99, which means it's outperforming, basically, that 99 is the top number. So it's outperforming almost all stocks in the whole stock market, and it's making all-time highs. So this is a leading stock. In fact, you can actually see in this black line, this is the S&P. You can see how it was going along with the S&P. S&P was rising since 2020, and this was also rising. And then S&P rolled over into its bear market, and this just kept going higher. That's the stocks we are always looking for in our stock picks service. And that's the stocks that we're looking at when we come back to this. Now we're looking at, like, this would be a Nasdaq Lantheus because it's got 4 letters in the ticker, LNTH. And so that was kind of a more of a Nasdaq-based stock. So what's going into this is, how are these leading stocks, the ones that are making new highs that are or near new highs, acting overall? So we're looking at how those are acting. Are the breakouts working? The number of stocks that are setting up that are leading stocks, the number of recent breakouts that haven't failed. Fails means that did it drop 7 to 8%, below the purchase price or the pivot point, which is where we're always looking. In other words, if we have say a cup pattern or cup with handle, the breakout would be from the handle. Has it fallen 7 or 8% or more from that? That would mean that the breakout failed. And sometimes we'll look at too as just has the whole pattern failed. In other words, did the cup completely fail in terms of did the price go below the bottom of the cup and now that pattern is just invalidated. We're also looking at the number of stocks that are trending above their 200-day, their 150-day, and their 50-day moving averages, which need to be aligned. So you have the 50 on top of the 150, 150 on top of the 200. Also going into this is the market internals and sentiment, market breadth, and the percentage of 52-week highs and lows. So we're looking at all those things to come up with this one number. And when we're not seeing these leading stocks acting well, that is telling you the market is not healthy. And I don't have it on this, but if you go back into our big master database, we never, I think we maybe got up to 50% for a couple days in the last, I think, since we started doing this. And most of the time it's been 25% or less or zero. And so really just and this has been going on because we've been seeing a stealth bear market in the Nasdaq, and then of course we went into a bear market. But this was tipping us off that leading stocks were just not working very well, and breakouts were on balance just failing or not going anywhere. So it is a super powerful indicator. Now again, coming back to the question, it's like, well, how could you have 100% in the indexes? And while we're only down to 15% here. Well, remember, the indexes, of course, are made up of stocks. But you can get a lot of major divergence, just like we saw last year and the beginning of going into 2022. We had this big mega caps that were holding up the market. So the indexes were creeping higher and higher. But when we were looking at the percentage of stocks above the 200-day, it was going lower and lower and lower. And it actually got down to, on the Nasdaq, I think was it 18% or something around there? In other words, 4/5 of the market was going down while the index was going up. So just bailing. And that's what was going on. So it's very misleading. So that's why this is for looking at just what's really going on in the market. This indicator has been very powerful, and it's just kept us out of the market for the most part for a long, long time. And we've been using this in the stock picks service too. In fact, I think we just moved to 0. There's almost no stocks setting up And they're really, the breakouts have lasted for most of this year. You're lucky if you got 2-3 days. And what's going on really is it's a lot of retail buying that's pushing up these stocks, and the institutions are selling into it. And of course, we need the institutions to be the ones that are adding to positions and buying positions over time, which is what they do. And without them, the stocks just really don't go anywhere. And we're just seeing, more and more stocks that are just, failing now outright when, in a healthy market environment, they should have been going up. Okay, well, that's about it for this weekend. I hope you guys all have a great and safe long weekend, Labor Day weekend. And we'll be back next week.